I have watched enough cycles to know that markets do not break the way newspapers describe them. They do not usually break because one headline sounds scary, or because one politician makes one loud promise, or because one television host finally admits that prices have gotten silly. They break when the buyer who used to support the market can no longer support it, and when the seller who never wanted to sell becomes the seller who has no choice. That is the moment the housing market changes character. Most people still think the American housing problem is a price problem. They think houses are expensive because houses got more expensive. That is true. But it is not the whole truth. The deeper problem is that the payment attached to the house changed far faster than the house itself. And when monthly payment outruns human income, you do not get a healthy market, you get a frozen one. I want to say that more plainly. From 2020 to 2026, the median house did not simply become somewhat more expensive. The cost of carrying that house exploded. A house that once felt merely ambitious now feels suffocating. A mortgage payment that once sat near the level of a car payment for many middle-class families now feels like a second rent, a second tax, a second life. If the monthly burden doubles while income climbs only modestly, you have not created prosperity. You have created a gate that millions of people can no longer walk through. Fay file site Fay turn 7 file 0 Fay. That is why I do not look at this market and see a normal real estate cycle. I see a pressure chamber. On one side of that chamber are ordinary families locked out by price rate, insurance, and taxes. On the other side are owners sitting on low-rate mortgages they cannot bear to give up. In the middle sit Wall Street vehicles, private credit structures, rental empires, and highly financed portfolios that were built on the assumption that capital would stay convenient. That assumption is now being tested. Fay site Fay turn 7 file 0 Fay, and when I say tested, I do not mean tested in some academic way. I mean tested the way gravity tests a man who has stepped too far out on a weak balcony. The central mistake many people make in housing is that they treat price as the truth. Price is not the truth. Price is the scoreboard. The truth is always underneath. The truth is financing. The truth is cash flow. The truth is whether the last buyer in line was strong, patient, and voluntary, or weak, leveraged, and desperate. Housing does not stay high because everybody feels optimistic. Housing stays high because the marginal buyer can still meet the monthly payment, and the marginal seller can still afford not to blink. If either side breaks, the market flips. That is the whole story. And I think a great many people are still looking at the wrong side of the board. They keep asking whether mortgage rates will come down and save affordability. They keep asking whether home prices will hold because supply has been tight. They keep asking whether America simply has a housing shortage and therefore every dip must eventually be bought. Those are not foolish questions. They are just incomplete questions. The more important question is this: what happens when one of the largest unnatural sources of demand in the market turns into a source of supply? That is where my mind goes. I have spent my life trying to understand what really moves an asset. And the answer is usually simpler than the jargon suggests. You only need to know who must buy, who can buy, who wants to sell, and who must sell. The difference between wants to and must is where fortunes are made in this housing market. I see 5 forces that matter more than the chatter. I call the first one payment shock. I call the second one the lock. In trap, I call the third one the Wall Street liquidation loop. I call the fourth one the equity mirage, and I call the fifth one the opportunity inversion. If you understand those 5 forces, you understand where this market really is. Payment shock is the easiest one to grasp and the one most people still underestimate. If the same house costs dramatically more per month than it did a few years ago, the number of qualified buyers collapses long before the number of interested dreamers does. Desire is plentiful. Purchasing power is not in 2020. The combination of lower prices and extraordinarily cheap mortgages made ownership mathematically reachable for millions of families by 2026, with prices materially higher and mortgage rates far above those old lows. The monthly carrying cost of the same median house had roughly doubled while income had not. That is not a small adjustment. That is a regime change. Fay file site Fay turn 7 file 0 Fay A regime change means behavior changes, Young families wait longer, move-up buyers stay put, first-time buyers rent, investors demand better numbers, speculators disappear, sellers keep looking backward, and the market slows. Not because people stop wanting homes, but because math finally overruled emotion. You cannot build a durable bull market in housing on nostalgia for 2021 financing. The next force is the lock. Entrap, people who bought or refinanced at ultra-low mortgage rates are not just homeowners anymore. They are prisoners of an old coupon. They are chained to an asset they might otherwise trade because giving up that old mortgage means stepping into a far more expensive future. A family may want a bigger house, they may want to move for school, they may want to relocate for work, but wanting and doing are separated by thousands of dollars a month. So what do? They freeze. This is why the usual relationship between affordability and falling prices has looked broken. In many normal markets, when rates rise, demand falls and sellers cut prices to meet reality. But this time, the existing owners with golden mortgages pulled supply out of circulation. They refused to sell because the trade was too painful. In one sense, that kept prices supported. In another sense, it made the market even more brittle, because a market that survives only by freezing is not strong. It is suspended. Suspended systems look stable until a different class of owner is forced to act. That leads directly to the third force, the Wall Street liquidation loop. This is where the story becomes interesting enough that most commentators get nervous. For years, institutional capital helped reshape the single-family housing market. Cheap money, post-crisis inventory, securitization, private credit, rental demand, and the search for yield all encouraged large pools of capital to buy homes as financial assets. Once that machine got going, ordinary buyers were not simply bidding against their neighbors. In many markets, they were bidding against entities with lower friction, easier access to capital, and a very different time horizon. That matters because institutional demand is not emotional demand. A family buying one house thinks in terms of school districts, children, memory, commute pride, and safety. A financial vehicle buying 10,000 houses thinks in terms of spread, debt service, exit optionality, net operating income, and capital recycling. One side buys a life, the other side buys a line item. When money was easy and rents were resilient, that distinction did not seem dangerous. It even looked brilliant, but the seeds of danger are usually planted during the years everyone calls disciplined, after the banking reforms that followed the 2008 crisis. More credit migrated outside the traditional banking system. Private credit expanded. Funds lent where banks hesitated. Structures grew around the idea that higher yields could be produced without the old balance sheet limitations. That world works beautifully until the borrowers start to crack, and the lenders discover that liquidity was more of a sales pitch than a promise. Fay file site Fay turn 7 file 0 Fay. Now think carefully about what happens next. If some of those large institutions face stress in private credit, redemption pressure, refinancing problems, defaults among borrowers, or simply a need to improve their balance sheets, they do not respond like a suburban family trimming restaurant spending. They respond by selling assets. And one of the largest asset buckets many of them own is real estate. In some cases, single-family rentals. In others, broader housing, linked property exposure. The point is not that every institution will dump homes tomorrow morning. The point is that a class of owner that once supported prices can become a class of seller for reasons that have nothing to do with neighborhood fundamentals. Faithfully cite Fay turn 7 file 0 Fay. That is how markets flip. Not because everybody woke up and changed their opinion, because the ownership mix changed. When the buyer of last resort becomes the seller of first necessity, pricing power shifts. That is the Wall Street liquidation loop. Credit stress hurts financial operators. Financial operators sell property to raise liquidity or cut risk. Additional inventory meets a buyer base already weakened by payment shock. Sellers compete. Price concessions spread. Comparables reset. Appraisals follow, lenders tighten. The next round of buyers weakens further. Then more sellers appear. That is a loop. And once a loop begins, The narrative chases the numbers after the money has already moved. I have seen versions of this movie in stocks, in insurance, in utilities, in banking, and in real estate. It is always the same lesson. Financial engineering is wonderfully elegant until it must meet an illiquid world. Then elegance disappears and only cash remains. The fourth force is the equity mirage. This is the one that hurts households most because it seduces them while telling them they are safer than they are. A great many people in America have been trained to treat home equity as a substitute for actual liquid wealth. They watch the estimated value on a screen climb, and they feel richer. Then they borrow against that number. They open lines of credit. They refinance. They spend against appreciation that has not been realized: boats, kitchens, vacations, tuition, debt consolidation, lifestyle upgrades, emotional relief. The invisible number turns into very real obligations. I have never liked that behavior. An owner-occupied home is shelter first. If it appreciates, that can be useful. If it protects purchasing power over time, that is nice. If it turns out to be a wonderful investment because you bought sensibly and held patiently, I will not complain. But a house you live in is not the same as a productive business, throwing off distributable cash, and the equity in that house is not money in hand until the asset is sold or the debt against it is serviced. People forget that because rising markets teach terrible manners. They start to think equity is permanent. It is not permanent. It is conditional. It depends on the next buyer, the next lender, the next appraisal, the next interest rate environment, and the next wave of supply. If prices slip 10%, that is not a trivial move in a market where many households already stretched to buy and then borrowed against the rise. For households with little true cushion, a seemingly modest decline can erase years of psychological comfort. For some, it can move them underwater. For many more, it can erase the illusion that the house itself was their retirement plan. Fay file a site, Fay turn 7, file 0, Fay. And that brings me to the fifth force, the opportunity inversion. Most people think falling prices are automatically bad news. That is the language of owners who needed permanent appreciation to validate a permanent lifestyle. I see it differently. A market becomes more interesting, not less, when price starts moving from fantasy back toward cash reality. If institutional sellers become active, if affordability pressure persists, if supply appears where people least expected it, then the American housing market could move from being a market dominated by fear of missing out to one dominated by negotiation. That is an inversion. During the upside panic, the weak buyer feels urgency and the strong seller feels power. During the inversion, the weak seller feels urgency and the strong buyer feels patience. I prefer the second arrangement. Now, I do not say that because I enjoy human discomfort. I say it because mispricing gets corrected only when somebody finally must face arithmetic. For years, ordinary families have faced arithmetic while large-scale operators often benefited from funding structures, scale advantages, and a financial environment that made carrying assets look deceptively easy. If some of that reverses, I would call it uncomfortable medicine, not a mystery. But you must be careful here. A housing downturn does not automatically mean every house becomes a bargain. A housing downturn means the lazy rules stop working. You must stop asking, will housing go up? You must start asking, which sellers are weak, which submarkets are owned by institutions, which properties still cash flow under conservative financing, and which assumptions break if rates stay high longer than consensus expects. That is adult investing. Most people want a slogan. I want a system. So let me tell you how I would think if I were an ordinary American trying to navigate this market without being fooled by either panic or cheerleading. First, I would separate shelter from speculation. If you are buying the house to live in, the primary question is not whether it will beat the stock market over the next 6 years. The primary question is whether the payment leaves you resilient. Can you carry it if insurance rises, taxes rise, or your income wobbles? Does the house improve your life, or does it merely advertise your stress? If the answer is that the payment would own you, then you do not own the house. The house owns you. Second, I would stop fantasizing about rescue from lower rates. Could mortgage rates fall? Certainly. Could geopolitical tension ease, inflation cool, and financing improve? Of course. But hope is not a strategy, and a market built on the hope of lower rates is a fragile market. You should underwrite the world you actually have, not the one a politician promised or a broker implied. In this world, rates have remained high enough to keep affordability strained, and the Middle East conflict was described in the source material as one of the factors complicating aggressive rate cuts. That means the easy money rescue many people expected in early the 26th of May not arrive on schedule. Fay file a site Fay turn 7 file 0 Fay 3rd. I would study ownership maps, not just price charts. If a local market has heavy institutional ownership, the behavior of that market can change much faster than the behavior of a market dominated by long-time families with low leverage. One neighborhood can look stable right up until one portfolio manager decides to unload 300 homes into the same zip code over 12 months. Another neighborhood may barely notice national drama because the ownership base is sticky, local, conservative, and not hostage to external balance sheet issues. Real estate is never one market. It is thousands of little courts, each with different players, different rules, and different pressure points. Fourth, I would demand cash flow sanity. If you are buying rental property, buy it like a grocer, not like a poet. Use realistic rent assumptions, use realistic vacancy, use realistic repairs, use realistic insurance, use debt that leaves room for life to happen. If the deal works only when everything goes right, the deal does not work. I do not care how clever the spreadsheet looks. I care whether the property still behaves when the world becomes irritating. Fifth, I would reject the equity mirage. Do not spend paper appreciation before it has become real. Do not make your life dependent on a refinancing window. Do not use your house like an ATM, and then act surprised when the appraiser or the lender decides your optimism is not collateral. Visible wealth and spendable wealth are not the same thing. The country forgets that every cycle. The people who remember it usually buy better and sleep better. Sixth, I would keep liquidity as a weapon in every turning market. The man with cash is underestimated for a while and then envied all at once. When sellers multiply and buyers hesitate, liquidity becomes bargaining power. You do not need to predict the exact month the market turns. You need the ability to act when the numbers finally make sense. People who are fully extended cannot exploit dislocations. They can only observe them. That is the investor's blueprint. Live below the payment that flatters you. Hold more liquidity than your emotional brain thinks is necessary. Wait for weakness to reveal itself. Study local ownership concentration. Buy only what works at today's financing cost. Never borrow against a fantasy, and never confuse a frozen market with a healthy one. Now, let me explain why I think this matters beyond housing. Housing is not just a place where families sleep. It is a giant psychological machine. When prices rise, homeowners feel richer. Lenders feel safer. Local governments collect larger tax bases. Contractors stay busy. Furniture moves. Appliances move. Brokers smile. And consumer confidence gets a lift. When housing stalls, all of that energy cools. When housing falls, especially after a long period of overconfidence, the emotional reversal spills far beyond the property itself. This is why I pay attention when a market built on scarcity starts facing the prospect of forced supply. Supply created by life is normal. Supply created by distress is a different animal. And supply created by institutions is more powerful still. Because institutions can hit a market with scale and because their decision-making is not sentimental, a grandmother may delay selling because she loves her garden. A fund manager sells because a spreadsheet says the capital can be used elsewhere, or because a credit committee said the exposure must come down by quarter. And that is why the flip in a housing market is really a shift in who sets the terms. For several years, sellers set the terms. Low inventory, cheap money, investor appetite, and narrative momentum let them do it. Now the possibility is emerging that math will set the terms. Math is colder than emotion and more reliable. If payment shock keeps buyers cautious, If lock-in keeps ordinary owners frozen, and if Wall Street pressure creates fresh supply, then sellers begin talking to one another through discounts. One reduction becomes a comp, one concession becomes a pattern, one distressed portfolio sale becomes a new reference point. Then the people who spent the last 2 years insisting housing can only go one way begin explaining why temporary softness is actually healthy. I have heard that tune before. What interests me is not the explanation after the fact. It is the position before the fact. That is where your life changes. The old identity in housing was built on passive faith. Buy whatever you can. Stretch because appreciation will bail you out. Treat low rates as normal. Assume institutions will keep buying. Assume your house is your wealth machine. Assume equity is real enough to spend. That identity was convenient, flattering, and in many cases profitable for a time, but it is not the identity I would want. Now, the new identity is strategic. You are not a chaser of listings. You are not a prisoner of headlines. You are not a tourist in your own finances. You are an underwriter of risk. You are a buyer only when the terms respect reality. You are a homeowner only if the payment strengthens your life instead of shrinking it. You are an investor only if the cash flow works without requiring magic. You are a saver of optionality that identity will feel boring in a market still drunk on old stories. I do not mind feeling boring when the arithmetic is on my side. And this is where I want to make an important distinction. I am not cheering for families to suffer. I am not rooting for neighborhoods to weaken. I am not pretending that lower prices are painless for people who bought at the top with sincere hopes. A housing downturn can hurt real people, especially those who confused access to debt with a margin of safety. But I also refuse to treat permanently unaffordable housing as a sign of national health. A market where ordinary working families must delay ownership for years while financial vehicles stockpile houses is not a sacred achievement. It is a distortion. If part of that distortion unwinds, that may be painful for some balance sheets, but it may also restore dignity to buyers who were turned into permanent spectators. That is worth saying out loud for too long. Many people have spoken about housing as if the only good outcome is for prices to rise faster than incomes forever. That is not prosperity. That is exclusion with better marketing. Prosperity is when ownership is possible without financial self-destruction. Prosperity is when a buyer can negotiate. Prosperity is when the payment fits a life, not the other way around. Prosperity is when a family does not need a miracle exit price to justify an ordinary home. So if the housing market is about to flip, I do not think the right response is panic. I think the right response is discipline. Discipline for owners means stop spending phantom equity. Discipline for buyers means stop rushing into suffocation because you are afraid of being left behind. Discipline for investors means underwrite for durability, not for cocktail party stories. Discipline for everyone means stop outsourcing your thinking to the last 3 years of price charts. Now, if I were laying out a simple operating protocol for the next phase, it would look like this. I would build a housing watch list before I build a housing opinion. I would track the local supply trend every month. I would study how many listings are cutting price versus selling above ask. I would look for markets with meaningful institutional exposure. I would ask local brokers which sellers are moving because they want to and which sellers are moving because something broke. I would compare rent to ownership cost honestly, not romantically. I would calculate the full payment, including tax, insurance, maintenance, and vacancy risk. If it is a rental, I would set a minimum cash reserve before making any offer. I would decide in advance what yield, payment ratio, and contingency margin I require, and then I would wait. Waiting is hard for people who think speed is intelligence. In markets, patience is often the highest form of intelligence. This is especially true when the crowd is still debating whether something is changing, while the balance sheets have already begun to answer the question. The reason I speak with such caution is that markets do not send engraved invitations before they reset. They send little clues. An executive order here, a shift in net buying there, a funding market under stress. A portfolio underperforming a redemption gate, a seller turning cautious, a rent multiple no longer making sense, An inventory trend no one bothers to respect, because last year's story still feels more comfortable than this year's evidence. Then one day, what was maybe becomes obvious, and by the time it is obvious, the best decisions have already been made by people who were willing to look early and think clearly. That is the test in front of you. Not whether you can predict every quarterly move in median price, not whether you can guess the next Fed meeting, not whether you can win an argument online about whether housing will crash or merely soften. The real test is whether you can stop living inside the old script. The old script said leverage is courage. The old script said appreciation is strategy. The old script said cheap money was normal. The old script said institutions made the market safer because they were sophisticated. The old script said your house would save you even if your own habits would not. I would not sign that script now. I would rather sign a different contract with my future self. I will not overpay to impress strangers. I will not count unrealized equity as spendable wealth. I will not depend on lower rates to rescue a bad purchase. I will not buy rental property that needs perfect conditions to survive. I will not confuse activity with opportunity. And when forced selling creates genuine value, I will be liquid, calm, and ready. That is how I would face this market. The housing market may indeed flip, but the deeper question is whether you will flip with it. Will you remain a spectator, repeating yesterday's slogans while the ownership map changes under your feet? Will you keep treating your personal residence like a slot machine with granite countertops? Will you assume the market owes you appreciation because it used to? Or will you become the kind of person who waits for arithmetic, studies the true seller, and buys only when the terms are good enough to survive disappointment? One identity leads to anxiety dressed as optimism. The other leads to freedom dressed as patience. In every major cycle, a point arrives when the people who were chasing the asset hand the advantage to the people who were studying the structure. I believe housing is approaching one of those points, and if I am right, the next winners will not be the loudest owners or the fastest clickers. They will be the people who understood a simple truth before the crowd did. A market flips when the forced buyer disappears and the forced seller arrives. When that happens, memory stops setting the price, reality does, and reality sooner or later always gets the final bid.